Thank you so much for being here. I hope you're enjoying your lunch. Folks who are standing in the middle of the conference room, would love to ask you to grab your seats. Please join me and put your hands together for the moderator of our next conversation, Kate Gordon, CEO of California Forward.
Come and sit down. Hey, everybody. Nice to see you. It's always challenging talking during lunch. I know you all want to visit and eat, but we're going to have a really good conversation. I am super lucky to be joined up here by Paul Bodnar, who's the Director of Sustainable Finance, Industry, and Diplomacy, which is a great title, Paul, of the Bezos Earth Fund, and who I know from his time in the Obama White House at the National Security Council, and by Colin LeDuc, who's the founding partner of Generation Investment Management and the head of the firm's San Francisco office. And you heard about him earlier as sort of an OG of sustainable investing. So very excited to chat with them. We're doing sort of a fireside chat podcasty. I'm supposed to be on this side, so you go in the middle. Podcasty type thing, very dynamic. So they are unscripted up here, so you should listen. All right, I'm coming over there. Hello, hello. Is this on? Yes? No? Maybe yes. Perfect. Thank you. Thanks for nodding. So we are talking about the state of climate finance. Hi, Paul. Hi, Colin.
Hi, Kate.
And I think the big question on everyone's mind is sort of what is the state of climate finance? I mean, we're in a really interesting moment in the overall climate transition, given the policy landscape, given shifting geopolitics. Just talk about what you're doing, where you are, what you do, but also what do you think the state of climate finance actually is? Colin, you want to start?
Sure. Thanks very much for having me. It's great to be here. I apologize. I was meant to be here last year, but I was sick on the day, so I had the daunting task of calling Suze and telling her I was not going to turn up to her event, which was kind of scary. But she actually invited me back. Yeah, and she even invited me back. So amazing. Thank you. Appreciate being here. As Kate said, I'm involved with Generation Investment Management, which is a sustainable investing firm that's been trying to prove the investment case for sustainable investing since we founded the firm back in 2004. And just so that you know sort of the perspective that I'm coming from, we do invest in both public and private companies. And we really manage money on behalf of primarily institutional investors around the world that are trying to fulfill their fiduciary duty by investing sustainably and outperforming. So our mission is very much to try and demonstrate that the best companies in the world and the best investors in the world are sustainable investors. So one of the things we do at Generation is we produce an annual sustainability trends report, which tries to take a kind of snapshot view of where are we in the transition to a sustainable economy. And, we're going to talk specifically about climate finance today, and I know we'll get into it, but, I think this is an extremely difficult time for climate finance, not just because of what's happened here in the administration, et cetera, over the last few weeks, but generally speaking, since Ukraine, the sustainable investing market has not performed. So in the world of capital allocation and investing, financial returns really matters, and that's the currency that we're dealing with. And unfortunately, if you look at the NASDAQ Global Clean Energy Index since Ukraine, let's just take the last 3 years, it's wildly underperformed the global stock market. Then if you look at the private markets, and there's a reason why I'm telling you this, which I'll come to in a second. In the private markets, there's a lot of companies that have not worked either. So there was a very large fundraise in Europe a few years ago called Northvolt. We were not involved with it, but a lot of people were. That basically went to zero. It was a 15 billion euro battery startup that went to zero. So what that does is it creates an impression that sustainable investing is not working from a financial perspective. Then you overlay, and there's a lot of reasons for that, which we can go into. Then you overlay the issues around the politicization of sustainability and ESG and woke capitalism and all the rest of it. And that has led to a pause. That has led to the tide going out. That has led to a moment where your people's conviction is being really tested. And you are at a point where a lot of investors are saying, of course I care about the climate, but this isn't really working, so why should I bother? And generally speaking, I think, I'm going to stop talking here in a second, but generally speaking, I think the market has also massively under-evaluated physical climate risk and the pace of physical climate risk, and overvalued the pace of the fundamental real economy transition. And it's basically got those two things really badly wrong in the last few years. And so as a consequence, people are very much reevaluating where climate finance needs to go, because the transition isn't happening as quickly as we thought or that some people wanted. And physical risk, climate risk is manifesting way more materially and quickly than the market thought. So it is the best of times and the worst of times. I'm happy to talk about the best of times bit as well, because I remain long-term optimistic. But this moment is tricky.
Thank you. Lots to unpack there. And I want to dig into all of it. But Paul, give you a chance for your kind of high level. What are you guys doing at Bezos, and also how are you feeling about the state of climate finance?
Thanks, Kate. Thanks for the invitation to be here. So I'm at the Bezos Earth Fund, which is a $10 billion philanthropy established by Jeff Bezos to support climate action and nature, the protection of nature over the course of this decade. And one thing I hope we'll talk about a little bit is kind of how do you understand the role of governments, corporates, the financial sector, and philanthropy in this story? Because many of you who are here at Haas or at the law school are wondering where you might fit into the picture after you graduate, where you should head, if you want to make a difference in this area or you want to be in the most exciting areas within it. And I think it's worth maybe talking a little bit about that and kind of who does what. But I think Colin said it really, really well. I before I was at the Earth Fund, I led sustainable investing at BlackRock in the best of times, then teetering towards the worst of times, and that was also an interesting experience. And I totally agree with what you said. I think there are a couple things though worth noting. One is this problem is not going away. And we will be dealing with it for decades, and it is the fight of our times. So just because the tide comes in and the tide goes out, it does not mean that we're going to suddenly give up and just focus on physical risk for the next 2 generations. I certainly don't believe that to be the case. The second just general observation I've had from the last few years is that there's a really big difference between investing in the green economy of tomorrow versus trying to wind down the fossil-intensive economy of today. And I think overall we are headed or have arrived at a kind of long plateau of emissions because we've done a better and better job of making a higher and higher share of new energy capacity come from renewables, right? EVs have grown. So the incremental investment in new assets is increasingly green, right? But unless we actually retire the long life capital assets that make up the emitting base of the global economy much faster, we're just going to bump along at this plateau. And I don't want to steal your thunder, Colin, but you make this good point that we're not just in an era of energy transition, but we're in an era of energy addition. So we can make all the addition clean, but unless we figure out how to, the global economy is full of long life assets, whether they're steel mills or power plants or trucks or buses or passenger vehicles that have lifetimes of several decades, and were designed to be in service for decades longer than the science tells us they should be if we are to be on track. So this story of capital stock turnover in the global economy is kind of the way I think about it overall. And the last sort of general observation, which is in line with what Colin said, is we have not yet begun to scratch the surface of understanding what it means to invest in climate adaptation and resilience. And it is not all a bad news story, because that's the way that I think, when I think of how capital markets think about adaptation, it's kind of this, it's a line item on a government budget is how most people think about it. But actually, climate proofing life on Earth is a growth industry in the 21st century. It's unfortunate, right? But so is the existence of the healthcare industry. Right? And we need capital to flow into it. We need innovation to happen faster. We need talent. If you think you're working on climate finance, do you think you mean decarbonization? Because you could also mean adaptation finance. And so think of all of the companies that are growing up today that don't necessarily self-identify as being in the business of resilience, but that are making the air conditioners, the water pumps, the drought-resistant seeds, the providing the engineering services, the wildfire analytics for utilities. There's a huge and very exciting piece of the climate finance puzzle, which, for unfortunate reasons, is really at the beginning of a hockey stick, I think.
Fascinating. The other thing on the adaptation and resilience point is we will literally bankrupt all our public budgets if we don't do something about it. So that's the other important thing for people to think about. But really interesting things to follow up on, and there's a million ways in. I am struck by the continuation of the earlier conversations from today into this conversation around, essentially what you're saying, Colin, back to you for a second, on this kind of transition framing is we need to be thinking about the bottom line impacts to companies of this climate situation. We see those much more clearly on physical risk right now because various things are happening. Ukraine is a great example. COVID is a great example that have changed the trajectory, right, of what we were saying was a transition. Can you talk just a little bit more about kind of your concerns about the transition framing and how do you, we heard a lot about different corporate forms earlier today. We heard a lot about disclosure. How are you thinking about kind of demonstrating to companies that this is a bottom line issue, that it's not a sort of an ideological or a policy conversation, but kind of getting people in the framework of why should we even do this? Why should we keep doing this?
Yeah, I think just to articulate a little bit about why we're having to have more nuanced conversations about transition as a framework. What seems to have happened in the last few years is that the low-hanging fruit has been picked by a lot of companies and a lot of investors, and they're now realizing that they're into the hard stuff. So it's actually costly to transition to a low-carbon economy, and it's actually really, really hard to shift the inertia of incumbents. And so the sort of early years of this movement were kind of easy because you could just sort of do a few things, buy some renewable energy, reduce some, whatever you were doing.
Behind the meter and everything was the same in front of it, right?
Exactly. So a couple of things have changed. We've now got to the hard bits, and secondarily, and probably way more importantly, the external context has changed dramatically for the worst. So I would really encourage everyone to listen to Johan Rockström about where we are in the safe operating zone for humanity. We are at record emissions this year again. This year will be, again, the hottest year on record. So I'm not sure I agree with you about the plateau of global emissions. We're certainly not a plateau of global warming. I'm not a scientist, but, my boss, Al Gore, is, kind of. And he talks a lot about this. And so we're not in a normal circumstance in terms of the urgency and the level of action that we are being called to work on, that we have been historically. One of my favorite charts, which is a daunting chart, is if you look at the emissions curve chart over the last 100 years, there's a little dip in 2020 because of COVID, right? But then we just go straight back up. If you want to reach anywhere near an economy that is not emitting on an annual basis, net emitting on an annual basis, we've got to take, emissions came down 5% during COVID, 5%. They need to come down at least 7% a year between now and 2050 for us to not smash through the thresholds of 2 degrees. So that, from an investment perspective, if you believe that, if you believe there is an imperative to do that, of whatever it is, a moral imperative, an economic imperative, whatever it is, most people just think that is completely unrealistic. We are not going to do that. We are not going to decarbonize anywhere near at that level. So what does that mean as an investor? It means you are running an enormous amount of extreme weather risk in your portfolio, an enormous amount. And you're also running an increasing amount of regulatory and policy risk, because if governments have a sacred duty is to protect their citizens first and foremost, and you are going to see that coming more and more of climate protectionism. And that will manifest in food security policy, that will manifest in indigenous energy policy, that will manifest in a whole bunch of different things around defense, which we can also talk about and should talk about, because the defense budgets are taking a lot of the climate budgets now. So there's a whole, I just want to make the point that incrementally still working on the stuff that we were working on over the last few years, we are challenged by what is going on out there. And so we need to constantly challenge ourselves that what we are doing is commensurate with the size of the problem without getting overwhelmed and discouraged. Because I do believe we're going to get to where we need to be in terms of the decarbonization journey. The question is whether we're going to get there in time or not. So the transition piece is to what Paul was alluding to earlier. We are not really replacing dirty energy with clean energy. That is not really happening. What is actually happening is clean energy is growing very quickly, which is a good thing, and needs to keep doing it. We're investing very heavily in that. But what's also happening is oil and gas is growing, right? And the high carbon intensive fossil fuel industry is still growing globally very, very quickly. And so to what Paul alluded to earlier as well, we also need to remove carbon negative finance. So things that are basically funding high fossil fuel growth continuously and continuing to put capital into more oil and gas reserves, which is exactly what's happening. This country is now producing more oil and gas than any other country has ever done in history, okay? So we are a petrostate. America is a petrostate. I'm not American, but I just say we because I live here. And so there's a lot of reality we need to face up to as a climate movement. I often feel that, we've got a little penknife and we're fighting against a nuclear warhead, And we need to focus in on removing fossil fuel subsidies, getting people to, reallocate capital to genuine low carbon that has a shot of not just being a little thing on the side, but truly displacing the fossil industry.
So much there. You guys keep saying a million things that I want to follow up on. But Paul, just following up directly, first I want to talk about the capital stock turnover point, which you both talked about, but dig into a little bit. And then this point about governments and the role of different actors. You made a point about capital stock turnover. I think it's really important. It struck me while you were talking, just thinking about California, right? I mean, Governor passed an executive order saying we're going to get to 100% electric vehicles by 2035 sales. We saw, in general, California policies on electric vehicles add cars to the California market that were electric, not transition the fleet away from internal combustion engines in general. Yes, a growing proportion of our cars is electric, but our number of cars grew substantially under COVID, actually. So that's an interesting example of not a turnover, but a kind of a sexy investment in a new technology that VC really liked. Speed and scale on investment, not necessarily leading to capital stock turnover. We kind of see that in a bunch of areas. I'm really interested in your thoughts about how we get there. Especially in the context that we're in right now. Also, yes, emissions went down 5% during COVID, but inequality went way up. Affordability became a major problem. A lot of political will for this stuff was lost, right? So how do we get there given the context of affordability, given the context of consumer sentiment, where we are today? There's a lot of interest in the sort of speed and scale John Doerr argument of invest in all the technology, the world is flat, build it all wherever, move really fast and break things. But where are we on the reality of kind of the nuts and bolts of capital stock turnover that you're talking about? How do we get there?
Okay, that's a lot too. Thank
you,
Kate.
Sorry.
Well, first of all, let's remember that this is a very important statistic that Colin said. 5% cut in greenhouse gas emissions in a year where we put the global economy in an induced coma. Now, and this gets to by the way, another topic, like this question of who's responsible for what. We are in, I would say, the tail end of an interesting experiment gone wrong in pushing the financial sector to move a lot faster than the real economy was moving. Right, so you had if you follow this stuff, you know, the Net Zero Banking Alliance, the Net Zero Asset Managers Alliance. We have some great leaders in the room who worked on that with me when I was at BlackRock. There was this push to get the financial sector corralled and behind the goal of net zero by 2050 and 1.5C. The problem was, particularly for fiduciaries, that, you know, you look at these emissions curves and you see this right angle that ought to happen right now if we were to be on track for 1.5 or even 2 degrees. And you go, okay, so if emissions were to go down starting immediately at 7 or 8% per year, is that a good thing for the economy as a whole? Is that kind of abrupt kink, like a right angle in a macroeconomic curve, generally a good thing, or is it a worrisome thing? And it was very hard for fiduciaries to say, yes, we're for that. We are for, you know, this like right angle in global emissions happening right now. And, you know, it's consistent with our fiduciary duty to our clients, and it's good things are going to happen alongside it. And I think that more than, frankly, the political pressure from red state AGs and so on is kind of what turned the tide against these net zero alliances, and the fact that, you know, if you were a proper bank or asset manager or asset owner, you really had to be signed up to 1.5C, because, you know, investors invest in the world as it is, and the world as it's likely to be. They for the most part don't invest in the world as it should be. And when the world as it should be is still in the process of diverging from the world as it's likely to be in terms of with the direction of greenhouse gas emissions, that created real problems for the financial sector. Now, to your question about capital stock turnover, I think that the role of the private sector can take the lead in building the new green assets and infrastructure and business models. The role of governments in that side of the equation I see as tactical. It's important, but tactical. Support basic R&D, support tax incentives, support streamlined permitting. But the role of governments in engineering a managed phase out of the fossil economy is not tactical, it's strategic. And governments do not have the political will today to really spend the money and the political capital to accelerate this wind down. There are exceptions we can talk about if you like in a number of U.S. states that have done ratepayer-backed securitization to shut down coal-fired power plants early. And coal is the battleground for this question of how do you curtail the lifetime of these assets. But we're going to have to do that for a whole lot of other major capital assets across the global economy, and we haven't even gotten started.
No, I think that's a really good point, and kind of continuing on to both of you. I mean, you sort of laid out the role of government is sort of to manage, right, both the transition, which is securitization, it's displaced workers, it's a lot of things, right? There's a lot of work in managing that transition and the pain of it in places, but there's also, government plays a huge role, to your point earlier, Colin, on the resilience side. My colleague, Numan Tarki, who's here, will speak later, and I do a lot of work at California Forward on the sort of public budget impacts of climate resilience. Right now, the government holds 99% of the risk of climate impacts, right? Because the government is the long-term risk holder. And so thinking about that, I think there will be less and less money, to your point, Paul, from the government to do the investment side. Thinking about that and thinking about what we were talking about before and sort of why should business do this, right? I mean, you were absolutely right. Russia, Ukraine, I'm really glad you brought it up at the very beginning. Huge impact on the energy transition, probably the biggest impact in building us into a petrostate. I'll say it too. We did that for Europe, though. That was you guys. So, you know. What kind of, you know, if, Paul, to your point, like GHG emissions and the 1.5, which you did a lot of work securing, so thank you for your work on the Paris Agreement. But if 1.5 and global GHG is not the thing that companies and investors are going to look to on a day-to-day basis, they're not looking to that. They're looking to their day-to-day business, what kind of metrics should we be looking at if not GHG emissions? Should we continue to use GHG emissions as the main metrics of success in this space, or should we be expanding into other metrics? Should we be thinking of different ways, also to an earlier conversation, of accounting, different ways of measuring, different ways of doing commitments? Like, what kind of metrics should we be using? Or do you think GHG still works, but we just need to rethink timescales or approaches? I'm asking really easy questions up here.
Well, look, I mean, greenhouse gas emissions have to continue to be a very important metric. This is just science, right? We have to keep our eye on the ball, and we have to focus on the long term, not just, again, incremental changes and incremental investment patterns in a given year. I think we're also probably at the end of a somewhat failed experimentation cycle on greenhouse gas accounting and corporate leadership metrics. I don't know what comes in place of or as an evolution of SBTI for those who follow this, but I don't think we've quite got it right in the way that we ask corporates to account for their emissions and incentivize them to reduce those. So I do think there's some soul searching happening. E-liability is one framework that folks are looking at. But yeah, we have to keep our eye on the ball of greenhouse gas emissions, those of us who work on this. It's just can't, I think the lesson from this previous period is it can't be the only thing. Like, you can't put your blinders on and say, everything, I will make every other objective or goal subservient to 1.5C as a pass-fail threshold. It just didn't work. Now, maybe it would have worked if we'd started this project 10 years earlier, because that was part of the issues. The world did rally around this scientifically correct goal, but it was just way too late. And, you know, we frittered away 1-2 decades kind of getting there.
Colin, your thoughts on metrics?
One of the professors, I think it was Andrew earlier, mentioned about objectives around capital allocation. I think this is a really, really important point because, and I'll talk about some innovation that we've tried to produce at Generation. But if you think right from the macro problem is that we're defining economic growth as what we're going after, right? Rather than well-being. And so that's a well-known mistake. The creator of GDP actually said, please do not use this as a measure of progress. But it has become basically the obsession of the global economy is growth, right? We all know that you can't grow infinitely on a finite planet. So, you know, most businesses are fundamentally unsustainable because you cannot grow in perpetuity. So what happens with this GDP obsession at the top level is it goes to the asset owners of the world, and they have a return requirement that is derived to some extent from the GDP growth focus, and for a need to deliver to their pensioners a certain level of return, which then goes to us, the asset managers, which is go and produce this amount of money for us, please, because it will help us pay our pensioners. And the objective is always really around this notion of growth. It is not, and there are ways to deliver that growth, but fundamentally we are not being incentivized as asset managers to deliver decarbonization. We're not. Our economy is not geared to deliver decarbonization. So the sort of cardinal sin is that we have the wrong objective around capital allocation. And so what we've tried to do at Generation is say, look, and Sue's mentioned it earlier, I think, one innovation you can do is to have impact-linked carry. So what that does to deal makers in our team, we have one fund in the Generation family that basically has 100% of the performance fee of the fund will get paid out only if the GHG reduction target is hit. 100% of the carry, okay? Not just 5% or 10%, 100%. So when you're dealing with private equity professionals who really care about carry, whatever the tax is on the carry, but they really care about that, they go looking for the highest impact things they can invest in that will deliver the highest possible impact because that's how they're incentivized. But they also have to deliver the financial return, but it's impact first. It's impact first. So they go to invest in steel. They go to invest in cement. They're not just chasing some AI thing or some latest software thing, which is a path of least resistance to 25% IRR, but you're getting no impact. And so the point is that unless we change the incentive system in the financial capital allocation process to delivering something apart from just financial returns, without material consideration around the incentives for delivering decarbonization, we're not going to get the capital reallocation. It's just not going to happen, And so for us to be able to we can dream up a beautiful fund, sort of sitting in our office, but if no one funds it, what's the point? So, this is where fiduciary duty becomes such an important consideration, because our funds are funded by fiduciaries, like institutional pension funds. Carstairs was mentioned earlier, just as an example. And so we have to be robust enough on a fiduciary level, from a financial performance perspective, to be able to deliver the financial numbers, but we want to do it in a way that genuinely decarbonizes. So I think this capital stock turnover question, corporate form, like all these things that have been talked about today, it's a lot about what are you trying to achieve with your capital allocation? It's not just let's make as much money as possible, and then everything's going to be fine, which is basically the framework of the last 50 years, which hasn't worked. Look what it's produced. We need a different objective. And so how do you instigate that? And that's true of businesses as well. It's not just investors, obviously, because we are at the mercy of businesses anyway, because we invest in businesses. So that's why we love purpose-driven, mission-driven businesses. We look for mission-driven founders who are looking for genuine sustainability commitment from us, their cap table. And what's one kind of small anecdote, now the tide's gone out a little bit on sustainable investing. What I'm hearing from entrepreneurs all the time now is, hey, I thought having XYZ big private equity name on my cap table was really going to help me because they told me they cared about impact. Now they don't care at all. Can you please help me clear them out? Because, they're basically trying to get me to do stuff that's non-sustainable. And so, there's a lot of greenwashing in the market for sure. But I just really wanted to try and crystallize the point around objective to capital allocation as a North Star.
That's super helpful. Go ahead, Paul.
Yeah, and I think it's also worth mentioning that to this point about what is the objective, what is sustainable investing, right? When I got to BlackRock, I realized how confused the entire industry was about the meaning of this term, right? On the one hand, you had ESG as a set of indicators that were basically trying to measure extra financial information and bring it into the investment process so that you could make better security selection decisions, right? And yes, gee, if you're in a service industry, you might want to know how happy the employees are. Or gee, if you're investing in a water-intensive industry, you might want to know how efficiently a particular company uses water. These are examples of E and S, and of course everything related to governance is pretty. It's good to know whether a company's well run and governed. These were not things necessarily to try to advance sustainability objectives, right? That's a whole other thing. If you want to structure a fund that has impact-based carry, and your whole goal is to create something that's focused on decarbonization, that is obviously sustainable investing in the sense that you are it's not just the business practices that are sustainable, it's the business models that you're trying to advance that are sustainable. So I think one big question here is what emerges from the smoldering ashes of ESG 1.0 in the market. And I think that I think that the good news is that Wall Street did kind of finally rally around the idea that climate risk is investment risk. And even when folks had to go to Texas hearings, big mainstream U.S. banks were okay saying, yes, this is about science and economics. It's not about ideology or beliefs. It's about, on the one hand, the impact of the climate on the economy, and on the other hand, the impact of the economy on the climate. It's just, I think that you can build a more generalized approach that could succeed ESG of sustainable investing that generalizes what we did with climate, right? Which is we said, look, the economy We live in a linear global economy. We've built a linear economy. We take, we make, and we waste. It just goes like this. So we take out a Mount Everest's worth of stuff from the earth every year, and we use it pretty inefficiently to make our relatively unequal economy, and then we waste most of what we've created. That is just the linear economy. That is just a fact, right? And now we've realized, oops, on the waste side of that, you have greenhouse gas emissions, and if they get into the atmosphere in sufficient concentrations, that will rebound and affect the economy. And regardless of what your views are about the environment and whether you like to close your eyes and imagine caribou wandering around the Arctic National Wildlife Refuge or not, you care about whether greenhouse gas emissions affect the economy. The same thing is true for natural capital on the front end of that take, make, waste continuum. So I do think that there's a chance to build on the ashes of ESG a purely science and economics based theory of sustainable investing that just focuses on the E, but doesn't get in trouble with ideology.
Could I just build on what Paul just said, which I thought was really interesting? I'm conscious that we've been pretty negative up here. So I want to focus on
about the ashes,
the
burning ashes,
which I
ESG.
agree with. But out of every, I'll just say quickly. So there's a prize in Europe called the Charlemagne Prize, which is basically awarded to a European that does the most for European unity every year. It's like the Nobel Peace Prize, right? So people are saying Donald Trump deserves that because
well, he's done a lot.
He's done more for European unity in the last week than he has than we've done ourselves in the last 30 years. Speaking as a European. Anyway, that's a side point. Was
this the good news part?
No. Well, there is some good news to it because I think
better than the Peace Prize,
people are waking. Anyway, we go down that rabbit hole, but I just want to make the point that let's not forget, right, that we are at record levels of clean energy investment. Right, we have tipped through, and we're a little bit below now, but the 2 trillion mark a year. 80% of additional generating capacity in the world that is being added is renewable and clean every year incrementally. We are at EV penetration is still growing very quickly. Yes, it has slowed, but that's because you're off a higher base. But we are still in a clear electrification transition. I could go on. So when it comes to the world that I occupy very, very, very tightly in terms of talking to institutional investors in particular, the level of sophistication of understanding sustainability and climate is very, very high amongst institutional investors today. And so they can see through, this is all part of the good news story, they can see through greenwashing. They really understand climate risk. They really understand that fiduciary duty involves sustainability and climate risk. They really are integrating tools. The teams they are hiring really understand climate. They are not buying the BS of the greenwashing asset gatherers anymore. They are focusing in on funds that can actually really make a difference. The international development banks are starting to help international capital get into the global south, which we haven't even talked about, which is where all future emissions are coming from, by the way. So you better get your arms around China, you better get your arms around India, Indonesia, Nigeria, Mexico, South Africa. That's where it's coming from, not from America or Europe. There's a lot of very good things to like. And the fact this room is packed, the fact rooms like this around climate conferences are still packed despite the tide going out, the level of activism, Al Gore runs a climate training program all over the world all the time, 3 or 4 times a year. Tens of thousands of people attend that every year. It's amazing. So I just want to make the point that, yes, the tide's gone out a little bit, but we are at a very different place when it comes to climate finance today than we were, 5, even 10 years ago.
Thank you for injecting in that, and it has, and Paul's earlier point too, just what we've already done has gotten us to an incredible place, and we have a lot of technology now to do a lot of the capital stock turnover you're talking about. I want to follow up to both of you, and either of you can answer either of these, but you talked about the Global South, which I was going to go to, and I'm super interested in both of you, your experience in doing international investment, what role you think government has in supporting investment into the Global South and into capital stock turnover of things that were built pretty recently in some cases, but not necessarily decarbonized. Coal transition in the Global South, huge challenge. What do you think the role of government is there? But also, and/or, the other big challenge, what do you think the role of government is on the natural capital side, to your point, Colin, on actually investing in land use change and natural capital, which has been such a sticky issue for private investment? What's the role of government? What's the role of the private sector in those two spaces? They're both really important.
Me to answer that?
Either one of you can answer either one of them.
You start.
So which government to help Global South?
I mean, is there
USAID.
a role? Is there a sort of a role of government in putting deals together, for instance? Right. Is there a role in the IMFs? Like, where do you see sort of the best levers? Because we haven't seen anything work that well yet, I would argue.
Yeah, I think it's coming. I mean, well, one of the things we're trying to avoid is a replay of colonialism, basically.
Really? That seems a bold statement.
Being basically British, like
we're quite
attuned
up
to
into
this.
Russia, China, and the U.S. I think
would
that's
be nice.
where
We'll try and take it. We'll try and take over America again. How about that? That didn't work out very well last time. King George and all that. No, I'm just. I think what. So when you think about, we don't want to sit in Mayfair in London and in San Francisco, New York, and say we're going to go and buy some assets in the Global South and everything's going to be fine, right? See how that worked out. So working with the local governments, I think, is the key. So Generation has 3 offices: London, where our headquarters is, San Francisco, and Sao Paulo. And so we are building a Latin American platform for decarbonization for institutional investors from the global north. Now, here's the problem. Interest rates in Brazil are about 12%. Okay? So you want to make a return, you've got to get over that cost of capital, right? You've got enormous amounts of currency risk. You've got enormous amounts of political risk. You've got, you name it, risk. So that's why the global capital markets are very, very clever. They're not dumb. So that's why people love investing in America, at least up until 7 weeks ago. Because it's generally seen as rule of law, safe place, great economy, blah, 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 right? All these good things, low-ish cost of capital. But how do you need local government, DFI money, development finance institution money, whatever form it is, we'll take anyone's, as long as it's de-risking that fundamental cost of capital. And helping us with the FX risk, the foreign exchange risk, and in some countries, the repatriation risk. So we are very worried in certain geographies about actually getting our money out. And I think, for example, we just did a deal in India, for example, that builds renewable energy to displace coal generation. So you go to the most coal-intensive parts of India and you build renewables, basically, and it takes, renewables displaces all the emissions from coal. And you need reassurances from the Indian government, from the state government, and how do you do that? I mean, are people going to respect the law anymore? I mean, it's sort of a question. And if you're an investor and all you care about is making money, as I was saying earlier, why on earth would you do that when you can just buy a software company in California? Like, why would you do that? You wouldn't bother. It's miles away. You don't understand it. You don't have any local relationships. You've got to make more return to make up for the risk you're taking. Forget it. It's too much of a headache. I'm just going to buy some American companies. It's like, so this is how investors are thinking. So the role of government is unbelievably important. The problem is that most of these institutions were created after World War II and are out of date. So, Bretton Woods, World Bank, all these things, IMF, they're all out of date. So they need to be rebooted, updated to the state of the world today to catalyze global green finance. Because we and many others are waiting for help, but we're not waiting passively. We're advocating for help to level the playing field. Because if we don't do that, capital will naturally just flow to safe geographies, into safe companies.
Interesting. Well, and we are remaking all of the post-war institutions, as far as I can tell. So that's an interesting moment to maybe think about that in a productive light, right, Paul?
Yeah, and so bad news and good news. I will come to the good news. If you look across the different ways that public and private investors, institutions are working on Global South clean energy, it's a bunch of creative and very subscale efforts, right? Blended finance, you've heard of blended finance, right? Where you have concessional and non-concessional capital in a stack. That can work, but each one of these blended finance vehicles is an artisanal creation, which can take years to negotiate among the LPs. I was part of this at BlackRock in the in the climate finance partnership that was a $680 million thing, a big fund of its type, but it took 3 years to negotiate the docs and get 3 family offices, 3 DFIs, and the institutional investors to agree on a structure which after 3 years had a very simple promise, which I think was great, which was, we can give you exposure to emerging markets, clean energy at OECD levels of risk. That was the pitch to institutional investors. But again, it took 3 years to negotiate the docs, and each one is a little bit different, right? So that's one challenge we have, which is that just the amount of brain power and effort that needs to go into creating $600 million worth of capital to deploy is just too much. And so how do we do that 2 orders of magnitude larger? I would posit that one thing we can do is to fill in the missing, there is no investment banking function in climate finance at the global level. It's no one's job to get private and public capital working together at the level of deals. Sure, at the C-suite level or Davos roundtables, everyone loves to lock arms and say the climate crisis is bad, and the president of the World Bank and my former boss, Larry Fink, everyone needs to cooperate. But at the level of deals, the sort of open secret is public and private financial institutions don't like working together. And there's a huge amount of friction to get them to work together. So one of the ideas that we've been developing at the Bezos Earth Fund is a kind of deal team for the planet, which is a group of folks that get up every morning and their only job is to drag big, gnarly, difficult climate finance deals closer to financial close. Just one good news, though, is I think you're also seeing super creative and interesting structures start to emerge in this space. And I'll just give you one example, something we worked on with Suze, who's not even paying attention to me right now. Hi, Suze. Which is, if you want an example of a super creative structure, can I describe this in a minute? So there's a German nonprofit foundation called H2 Global. And they basically set up the world's first market maker, public purpose market maker for green fuels and green commodities. And what they do is they get a slug of capital, concessional capital from a government, and they use that to endow a balance sheet, which is then used to buy and sell, let's say, green hydrogen. So the problem in these nascent markets is that you've got sellers, producers of, say, green hydrogen that need 10-year offtake agreements and high prices for offtake in order to go get a bank loan to finance the facility, so it's not just done with equity. And on the other hand, you have the end users of these hydrogen and its derivatives who are tiptoeing into the hydrogen space themselves and want to sign a 1-year offtake agreement or a 2-year offtake agreement at a price that's benchmarked against the fossil alternative. And so a market maker steps in the middle and says, I am willing to take the price, I'm willing to pay the green premium, and I'm willing to warehouse some of the risk. And it's kind of like a starter motor that does the first deals in a market, creates a forward price curve, and kind of gets things going. Well, one innovation that on top of what these guys have done at H2 Global is now 2 regional development banks are talking about issuing sovereign loans. Like, I'll give you an example in Brazil. Brazil imports fertilizer, but it has incredible conditions for producing green, so it imports fossil-based fertilizer, but it has incredible conditions for producing green fertilizer with local renewable energy. Great. So how do you do that starter, create that starter motor? Maybe the Brazilian government doesn't have the money to do that sitting around. Well, the Inter-American Development Bank is talking about lending Brazil $1 billion to endow a market maker, and their models show that the tax revenues that will accrue to the Brazilian government from jumpstarting this local industry, including exports, will be more than sufficient to repay this loan to the IDB. Now, who knows if it'll work, but it's a great example of some cool innovations happening.
Great example. Susan and I were actually talking about this in the circular bioeconomy space yesterday, where we might need somewhat of a market maker. So it's sort of an interesting approach. We only have 5 minutes, so you can go ahead if you want to jump in on that.
No, I was just going to say,
one last question.
This idea of a banker for the planet. I mean, John Goldstein's here from Goldman Sachs, who could always tell us why Goldman's is not that bank yet. But maybe Goldman's will become that one day. No, I'm kidding. I mean, I do think there is a function there that's missing around the Green Climate Fund has tried to do it, to be a little bit of a broker of deals globally, but there is a function missing there in the global 100%. Governance infrastructure.
100%. And it's part of what the international team at the Department of Energy, when I was there, tried to do on the net zero initiative, but I think challenging to do from right inside government. It's a really interesting question of how to do that sort of more globally. We have a very little time, so since Sue's invited us, I'll ask a Sue's related question to end up here, which is one of the things we've been talking about and we keep coming back to on this panel is business. It's not in the core incentive structure of business to do many of the things we're asking, to do many of the things on the time scale, to solve sort of externalized problems, just a number of things. Is there a role for government in pushing public benefits corporations, not just assuming the best intentions of the companies that say to the investor, we have good intentions, we're going to do this well, we're going to sign commitments that we may later get out of, but to actually say, we here government are going to de-risk, we're going to do deals, we're going to push for this, but as in return, we want to see corporate form changes. Is there an opportunity for that?
Yes.
Look at that.
Yeah, I mean, I think absolutely. I mean, I think it's clear the free market without guidance is not going to deal with these externalities in any way that's going to be sizable enough. And so what I do think is interesting is this distinction between are you sustaining a degenerative system, or are you actually having an impact on birthing a regenerative system? So, there's a lot of work that's wasted on sustaining a system that clearly doesn't work. So I think governments have a very important role to play in getting us shifting to a regenerative frame that goes beyond sustainability.
Thank you for that. Paul, any last thoughts on this?
Well, I mean, I think you might have covered this in this session. I mean, you just need really clear incentives for investors to invest in these companies. You'd need tax incentives, probably. And so Suze and team can brilliantly solve the corporate form issues. I think the question is, how do you get, I mean, in general, how do you get this to not be a niche specialist corner of the economy, right? There's a great piece you should all read called "It's Not Easy Being Green" by Deloitte about like the archetypes of sustainable asset manager. You have to, if you Google it, you have to add Deloitte, otherwise you get Kermit the Frog videos.
Which are good.
And it talks about specialists. And the fact that you will have the fun place to work is a generation, not a BlackRock, if you want to work on this stuff. And similarly, how do you create these sorts of new systems that break out of the niche? And you have to be very clear-eyed about what it takes to do that.
Excellent. I mean, and I know we're just about out of time, but I love that we're sort of coming to both bringing the messaging and the incentives toward the interests of investors in business and bringing the systems and investors in business toward the reality of climate, the urgency of climate change. So it's really both, and it sounds like is what you're both saying. It's not there's not like one magic bullet solution, which we all know, but.
I would just say one final thing, if I may.
Absolutely.
I do think the investment community or the asset owners as well as governments understand that we're running with very, very high levels of climate risk in the system. So the insurance companies and the big asset owners of the world, the sovereign funds, are starting to say, how can you help us de-risk systemic climate risk, not just company-specific climate risk? Because if you're a $500 billion pension fund, you own the economy. So it's not just about individual assets being resilient. They're worried about taking risk out of the entire system. And that is, I think, increasingly in view of central banks, insurance companies, and sovereign funds. And so you'll see the sovereign funds playing a much more important role in this world, in my opinion, in the next kind of decade.
Thanks so much. Go ahead. Last word, Paul.
Last word. Just if you're a business school student or a law student, I would just say, this is, contrary to appearances, actually the golden age to get into this field. I got into this field 25 years ago when I was doing carbon market stuff to deal with a problem no one had heard of, even climate change, much less, a treaty that wasn't in force and all the rest of it with the Kyoto Protocol. So I would say professionally, buy the dip because, the conditions have never been better. You have a generation of VC investors, for example, who really understand climate tech. Right? You have infrastructure investors. Every big infrastructure investor and PE platform now has real expertise on climate. Of course, generation's the best. But and so whether you're interested in tech or the legal innovation or financial innovation, maybe in public policy, you take a little break for the next few years if you're interested in that. But there's so much inspiring stuff happening. So please come talk to us about it. And
thank you. That's a great way to end. And the other thing is everyone who works anywhere will be working on climate, regardless of where you work going forward. So thank you both. Thanks to the panelists, Paul, Colin. Amazing conversation. Thank you.